bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the December 16th, 2025 episode. My guest this week is Christina Apostolidis. Christina is a partner in Novogradac's Naples, Florida office. Christina is one of Novogradac's leading experts with respect to low-income housing tax credits. In this episode, Christina and I will discuss three issues or three cost categories and how a developer goes about determining if those costs are includable in an eligible basis. Now, all developers of affordable rental housing face questions about what's includable in an eligible basis. And the three that we're going to focus on this week are the treatment of community service areas and common areas, the treatment of offsite costs, as well as the treatment of impact fees. We're going to tease out what each of these mean and how you determine if they're includable on an eligible basis in the course of the conversation. Now, for the members of our audience who are craving a deeper dive in these issues, or otherwise want a deeper dive in all things low-income housing tax credits, I encourage you to attend our 2026 Affordable Housing Developers Conference, which will be holding in Fort Lauderdale, Florida. During that session, or during that conference, I should say, we will have a panel on development challenges and solutions, as well as a panel entitled Opportunities for Specialized Housing. That second session will focus on housing for veterans, transitional housing, permanent supportive housing, and other housing for targeted renter populations. This won't come as a surprise. I'll include a link to the conference in today's show notes. Now, today's episode is the latest in our Tax Credit Tuesday recurring series, So You Want to Be a LIHTC Developer. This is a series that we designed to help developers, investors, syndicators, and others learn more about financing affordable rental housing through the as a developer with low-income housing tax credits. I will include a link to a playlist of all of our episodes in the So You Want to Be a LIHTC Developer series on YouTube. I'll include that link in the show notes. Now, before we dive into today's episode, I do want to share a quick piece of programming information. This is our last episode for 2025. Thank you for joining us over the course of the year. It's also our 899th episode of Tax Credit Tuesday. What a coincidence. So that means when we start back on January 6th of 2026, we're going to start the new year with episode 900. That's a lot of Tax Credit Tuesdays. We hope you'll tune in throughout 2026, whenever you can, and on whatever source platform, podcast platform that you use. For now, let's jump into today's episode. Christina and I have a lot to discuss. So if you're ready, let's get started. Christina, welcome back to Tax Credit Tuesday.
Thanks, Mike. Happy to be back.
It's good to have you here. This is your sixth appearance on Tax Credit Tuesday. I do remember the time you recorded during your vacation in Greece. And I appreciate that. Fortunately, you don't have to do that this time. Your last appearance wasn't in Greece or from Greece, but it was in December of 2024. And that was yet another installment in our So You Want to Be a LIHTC Developer series. And that episode covered the importance of updating forecasts before year end for low-income housing tax credit properties. And I mention that now because if you're listening to this now, there's still time to update your forecast before year end, but there's not much time left. And for our viewers and listeners who haven't seen you before, please share a few words explaining some of the many services you provide to Novogradac clients.
Sure. Thanks, Mike. Happy to be back. Just for our listeners and for those who don't know me, my main focus is working with affordable housing developers. So that's why I typically am on these So You Want to Be a Developer podcasts. But I work with developers and syndicators in various aspects of a project's life cycle. So including from the beginning, doing compilations of financial projections, some consulting on project structuring or eligible basis issues that we'll talk about today. Do a lot of work with 10% tests, 50% tests, 95.5 tests. The 50% test, known as that finance by test, or changing, the rules changing here shortly, but also do owner's final cost certification, general contractor cost certifications, and then first year credit calcs, and also break-even analysis, and then just our routine annual audits of financial statements and tax returns, just to make sure that the projects and the partnerships are in compliance with investor requirements and other regulatory requirements. So a lot in the LIHTC space.
That's right. And this year it's the 50% test. And for the projects placed in service this year that you work on next year, it'll be the 50% test. But for those that get bonds financed next year of at least a minimum amount, you'll be starting to look at 25% test.
Yeah.
We have a new test. So thank you for that. And one of the services you mentioned was cost certifications, which is always a critical part of the development process, where you determine what a taxpayer or project's eligible basis is, which is the foundation for determining the amount of tax credits you have. So the three issues or the three cost categories we're going to talk about during this episode, the first of which is costs related to common areas or community service facilities. So if you could give some examples of common areas or community service facilities, and then I want to follow up with some questions about how you determine if the costs associated with those common areas or facilities are included on an eligible basis.
Yeah. So we wanted to cover community service facilities because there's some nuances to it. Community service facilities can be thought of as a common area, right? So most projects are going to have common areas that we typically see, such as community rooms, parking lots, playgrounds. And our common areas are there for our tenants to use, usually whenever they want, right? And usually free of charge. And we compare that to community service facilities. Community service facilities are, again, a type of common area, but are there to serve individuals and families with lower incomes. But it's not, community service facilities are not just for the tenants of the building that we're discussing. It could also be opened up to non-tenants as well. So that's one of the differences when we're thinking about community service facilities versus common areas of a LIHTC building. One thing that we do want to watch out for, so when we're thinking about common areas, we mentioned that they're usually free of charge. And we want to watch out because if there's common areas that we are charging a fee for, that can potentially be considered a commercial space. And commercial space is something that, since we're charging the tenants for, the cost to build out commercial space is not considered eligible basis. And as we get into further our discussion, community service facilities, you may be able to charge a reasonable fee for that space. So we'll get a little bit more into the nuances. And I do want to give some examples, a little bit more examples too.
Please.
So for common areas, like I said, we think about swimming pools, right? The community lounge areas or playgrounds. Again, these are amenities. We kind of think of them more of it as amenities for the tenants, particularly when we're doing the cost certs, right? We're always looking out for amenities and making sure that the treatment it's being treated correctly. But community service facilities, again, are a separate group. Again, these usually or typically can include provide services for people that don't live on the property. And community service facilities, typically we see them sometimes in projects that target other populations or specific services. So I usually see them a lot in our permanent supportive housing projects or other types of housing that's kind of specializing, right? So they're having some extra services in those facilities. So when we think of community service facilities, sometimes you might see daycare centers as part of the building. Again, they can service that building, but also the community or the area that it's in. We might see career counseling offices, literacy and tutoring programs, rec centers, or other spaces for maybe health care. Again, thinking about my permanent supportive housing, sometimes there's on-site health care that's provided and counseling to the tenants.
So when you think of common areas, as you noted, swimming pool, things of that nature, there's no separate charge. And as a consequence, there are common areas that they would generally be included in eligible basis. And as you noted, with respect to common areas, if there is a separate charge and it's optional, then the optional charge is not treated as rent, but the common area isn't included in eligible basis. And if there was a mandatory charge for a common area, then that mandatory charge would be treated as rent and the common area would be included in eligible basis. I think I have that said generally accurately. Do you agree?
Yes. Right.
Okay. So now let's turn to community service facilities. And that's an area where, as you noted, it's a separate facility. It's not designed principally for the benefit in most situations for just the residents. And there often are additional charges for those facilities for the use. And as a general matter, you would look at that and say, well, that would mean those areas aren't included in eligible basis. However, Congress didn't like that answer. So there is a statutory provision that does allow community service facilities in certain circumstances to be included in eligible basis in spite of having additional charges as well as serving non-residents of a given property. So please explain for our audience how this provision works within the tax code to allow certain community service facilities to be includable in eligible basis, or at least a part. There's a calculation you have to go through, which I want to ask you about. But first, if you could just describe the overarching rule in the tax code.
Right. Yeah. So community service facilities are defined in Section 42 of the code, and they're defined as areas serving people whose income is 60% or less of the area median income, which is great, right? Because that's what our LIHTC properties are usually serving. So that one's usually pretty easy to meet. And again, they're not just for the benefit of the tenants, but also for the wider community. Next, the facilities need to be located in what's called a qualified census tract, or a QCT. So that's an important part to remember. So the QCT, again, for maybe our newer viewers, it's a designation from HUD, and it tells us which neighborhoods have higher concentration of low income households. So either you're in a QCT or you're not. It's a pretty clear requirement, but it's sometimes easy to kind of forget that one, just maybe because it is so easy. So if you have a community service facility in your building, but for some reason the building's not in a QCT, then it wouldn't qualify as a community service facility. So again, I think just sometimes because it is such an easy one, or just such a black and white one, it's an easy one to forget. So you want to make sure we keep that one in mind. And then also, if you're developing maybe several community service facilities within the same building, or there's maybe different parts, they're considered one for the purposes of following the rest of the rules and figuring out how much basis is allowed to be used. So all the community service facilities within the building would be considered one, and they'd all have to be within the building or within the same tract of land within the LIHTC property. What next? And so also, like, again, community service facilities, they're not amenities. They're not just nice little extras. They're there, to provide essential services to the LIHTC development, to the tenants, and to the community. So again, as long as we're serving individuals at or below 60% of area median income, they're located in a QCT, and they're all located within the housing. It's a good start. And we're meeting the requirements of Section 42. Along with Section 42 and within the code, there's more guidance that we have to look to. And so part of that guidance is in a few revenue rulings that have been issued that give us some more guidance. Again, part of this guidance, it clarifies that in order for the facilities to be considered eligible basis, the intent is that we want to make sure that those facilities are providing quality service to the tenants. Some of the things that the IRS looks for within that guidance is that the facilities are suitable for the tenants' needs. So again, is it something that's benefiting the community and the needs that they have within that community? Are those facilities providing helpful resources or support? And then if there is a charge, are the services affordable and accessible to the tenants? So we want to make sure, again, that it's suitable, that it's helpful, and that if there is a charge, it's affordable. And how do we know that, right? How do we know
Right,
that
exactly.
it's actually suitable, and that's what the community needs? So when you're doing your market study, so every LIHTC project, when it's applying for a tax credit, it's going to go through a market study, which our valuation group at Novogradac is great at doing those. They understand the market. But one aspect that you're looking at when you're doing the market study is looking at, does the facility, meet the requirements from these revenue rulings that are issued? Again, is it helpful for the community, and is it needed? Basically, is what the market study is looking for. So you're going to include, you want to have all that done when you're doing your market study, so that you can prove to the IRS that yes, we considered this when we were applying for tax credits, and yes, the facility is meeting the requirements that the IRS specifically is looking for.
So thank you for that. And, I always like to say, whenever I'm thinking about the luxury tax credit or other tax incentives, I always look at additional rules that Congress put into place. And oftentimes those additional rules are designed to limit the ability of taxpayers to use a particular incentive in ways it wasn't intended. And if I sit here and think about community service facilities, and I think about the words, the way in which you describe what a community service facility has to satisfy to be eligible, to be included in eligible basis, I could think to myself, well, maybe I ought to go out and build a property, and I'm going to have, 10 units of housing, but I'm going to have this massive community service facility. And everything that you just described, I would satisfy. And that would mean that my massive community service facility could be includable on an eligible basis, even though there's only 10 residents across this massive facility, which would in essence be a backdoor way of turning the local housing tax credit into essentially a community service facility tax credit. So because of that risk, Congress saw fit to create percentage limitations on the amount of eligible basis of that community service facility that could be included in tax credits. And the amount of the basis of this community service facility that can be included in eligible basis is a function of the cost of the property overall. So if you could explain to me what the limitation is on eligible basis related to community service facility that's part of a luxury tax credit development.
Yes. So assuming that the community service facility meets all other eligibility criteria that we discussed, the code sets in a limitation to calculate a maximum amount of cost that can be included. And so what that calculation is that 25% of the first 15 million of eligible basis of the project plus 10% of the remaining eligible basis above 15 million. Okay, so as a quick example, a project with a total eligible basis of 20 million, first we would calculate 25% of the first 15 million. So 25% of 15 million is 3.75 million. And then our remaining basis above 15 million, so that would be 5 million, would be calculated at 10%. So 10% of 5 million is 500,000. And so our 3.75 million plus 500,000 would be a limit of eligible basis on the community service facility of 4.25 million.
Right.
Pretty
Hopefully,
straightforward calculation, but yeah.
now hopefully that kind of explains what, so it ends up being, somewhere above 10%, but below 25% for properties in excess of 15 million, somewhere within 10 to 25% of your eligible basis can be attributable to a community service facility, so that in essence, a community service facility can't be outsized relative to the size of the long-term tax credit development. So let's move on to our next topic. So we've dealt with common areas and community service facilities. Let's move on to off-site improvement costs. And just like we did on the prior question, if you could first just give some examples of what we mean with off-site improvement costs or off-site costs for a given residential development. And then we'll get into the ways in which you determine if it's includable or not in an eligible basis.
Sure. Yeah. So for off-site improvements, when we refer to that, we're thinking about costs for work incurred on parcels outside of our project, right? So when we're looking at our LIHTC project, we know which parcels, there could be multiple parcels, but those specific parcels belong to the main development site. So offsite improvements are work that happens outside. So think about maybe like the immediate surrounding area. So maybe some roads right outside or outside of our development. Could be roads, could be some utilities, some curbs, some street lighting. So things that happen outside of the boundaries of the project.
And then when we think of offsite costs, I know there are a couple of factors that you need to be thinking about. One is who's responsible for maintaining the cost. If it's an offsite cost, but you're still responsible for maintaining it, it could be depreciable, such that it's a depreciable asset. If you have an offsite cost and you dedicate it to the city, then you don't have any maintenance requirements in most cases, such that it's really not, quote, depreciable. So I know that's one of the factors you take into account. And then you also have to look at whether or not the building itself benefits, if you're incurring the cost because you want to build a building, or if you're incurring the cost because it increases the value of the underlying land. So there's this notion of, you've incurred the cost, was it a condition to getting a permit, or was it to make the land itself more valuable, the property itself more valuable, and doesn't have any depreciable life? So those are a couple of the factors to be taken into account. If you could kind of build that out and explain, how developers should be thinking about an offsite cost, and is it or is it not going to be included on an eligible basis, with obviously they want it to be included in an eligible basis so they can include it in their tax credit basis to, generally speaking, claim more tax credits.
Right. Yeah. So offsite, there's kind of multiple areas or layers where an offsite cost can fall. It can get a little tricky, and you really have to look at the fact pattern of your project and the facts and circumstances, because certain things could be the same cost, right, for one project, in another, but maybe where it's located or some of the other factors can determine whether it's basis or not. So generally, offsite costs are not included for eligible basis, but we look to some private letter rulings that have given us, maybe some kind of thoughts onto how the IRS will look and treat certain costs. So there are some favorable private letter rulings that kind of, allow us to categorize offsite costs, the offsite improvements, into maybe some different buckets. You have to be careful though. So when you are looking at your offsite improvements, you want to kind of walk those through with your tax credit experts, and just see if they meet a certain fact pattern, right, and how they should be categorized. One thing to keep in mind is, if you have offsite improvements and they directly benefit the project and the tenants, that's one thing that we're looking at to see if those qualifying improvements will be included in eligible basis. So again, you want to see, are those costs directly benefiting the tenants? So some of those costs could be, like an access road that leads into the project, right? Making it accessible for tenants to get to the building, right? It's necessary. Curbs along, adjacent to the building, street lighting that provides security, right? So that's, again, directly benefiting the tenants. Those are things that typically and generally, we could consider offsite and eligible, things that we want to keep in mind. And then, like you mentioned, Mike, maybe there's offsite cost that don't directly benefit the tenants because maybe they're located a little bit further, or maybe, it's having to do with, some utilities or some, other, things that are off the main project site, but they were required, right? So think about projects that maybe are built in an area that maybe there wasn't already some build out included, maybe, sort of a new area or kind of a new section of the city, or, where the building is, maybe there wasn't too much infrastructure already there. So, there's going to be certain requirements maybe by the local city to provide some of that infrastructure. So those are what we consider the dedicated improvements. So again, kind of a subset of offsite improvements that might not necessarily be a direct benefit, but it was required to build that new LIHTC building.
No, thank you for that. I definitely find the concept of is it dedicated or not is a critical factor. And just for our audience, the reason why dedicated matters is if it's dedicated, then generally speaking, the property owner doesn't have the obligation of maintaining it. So it doesn't wear and tear from the standpoint of the owner of the property. So it's not depreciable. So the question just becomes, should that cost be more attributable to the land because it makes the land more valuable indefinitely, or does it accrue to the building itself in the sense that that building wasn't there, that those improvements wouldn't necessarily make the land itself more valuable? And that's one of the questions about dedication. And if it's not dedicated, then you have to maintain it, then it's depreciable because if it's subject to wear and tear, which generally speaking, these sort of improvements do wear over time. So that's one of the critical points of the sort of dedication. And yeah, I liked your point about access roads to the property, because if it's an access road to the property, then irrespective of what's there, the land, generally speaking, is more valuable because you have to have access to the property. But if it's an extra access roads, now the city requires 2 instead of 1, then the question becomes, does that extra one really add value to the property, or is it just a condition to get your building permits, in which case it would be capitalized and included in eligible basis? And the one that I always like to think about is a left-hand turn lane into your property. It's like a left-hand turn lane into your property makes the property, you think of it as a general matter and say it makes it more valuable, but if it's a cost you didn't want to incorporate, but you had to have that left-hand turn lane in order to get your building permits, then you would say you could make the argument that it was needed in order to move forward with the building, so it'd be capitalized. And I guess I would just say, and you can weigh in on this, it seems like with respect to any sort of offsite improvement costs, as a general matter, the more documentation you have that it's a condition to building the building, the better you are in terms of arguing it's a depreciable cost. Would you agree with that?
Right. Because there could be some, like you said, some cost that might be more tied to land as opposed to the building. So
Right.
definitely want to walk it. And, you might have, I feel like sometimes, the tricky part when we're doing cost certs is that, the costs might all be in one bucket. We're looking at a general contractor's draw, and there's, one category of, sometimes they call it just site improvements. So you need to dig in deeper and see, okay, what was in there, right? And some of it might be tied to the building, some might be tied to land. So we want to make sure that you're really digging down into the details.
No, I definitely want to. And then when you're in the development phase and you're negotiating with the city about offsite improvements, sort of drawing that connection between those offsite improvements being a condition to getting the approvals to go forward with the building. And the more of that documentation that you have, the better when you are, as you point out, going through and looking at those different costs, you can say, well, this cost I would not have incurred, but for the fact that I needed to build the building. And you have that documented somewhere, that's going to help support including eligible basis. If you don't have that documentation, that may be an argument that's harder to make.
Right. Yeah, and that's a great point, Mike. I think we've seen that recently with
Right.
deals we're working on, is getting your cost up front, itemized and knowing kind of what's in it and what bucket everything's recorded in. So
So you're saying someone shouldn't come to you after they've built everything and say, now do the cost certification. Maybe they should come to you before they've even started building anything.
Yes, and we do
even
appreciate
finished
that. We do
negotiating?
get those calls, and we do definitely appreciate that then, because then we can, we can start having calls with the general contractor and just making sure that, they
Right.
know what's important, what we're going to be looking for. So we definitely like starting those way ahead.
No, and that's one of the reasons why the moment, a forecast is getting developed, focusing in on what's an eligible basis and not, and analyze all these questions so that when it comes time to actually do the cost certification, all these issues have already been resolved. And if you resolve it early, the arguments for including eligible basis can be much stronger.
Right.
So let's our third category of costs. We've talked about community service facilities. We've talked about offsite costs. Now let's talk about impact fees. And just like we've done before, first describe what an impact fee is.
Okay, yeah. So impact fees, they're usually payments that developers or property owners make to local government agencies. So it could be the local city, county, or even school districts. So when something's being built, the local government agency will apply an impact fee to that developer to kind of help offset the extra cost of public services and infrastructure that's going to be needed, because now we have a new LIHTC building with new tenants, residents that are, going to, cause more traffic, right? And more, maybe more students in the build, in the neighborhood.
Right. We might even say to help offset the impact
right? The
that
impact.
property is going to have
community,
on all these other systems.
Yep. So, some things that impact fees are used for are to build water and sewer systems, roads improvements, new schools or expanded schools, and other facilities for the community. So again, it's there for local governments to make sure that the existing residents aren't stuck with all these additional costs, right? They're putting that cost off to the developers.
So when you think of impact fees, it's kind of like what we just were talking about with offsite cost. You look at an impact fee and you say, on the one hand, one-time charge, and it's to allow you to build this building. Now, arguably, it's a condition of building the building, so it goes into the cost of the building. On the other hand, if I were to tear the building down and not have to rebuild a building, I don't have to pay the fees again, then maybe it's the land that's sort of worth more because of this impact fee, in which case it wouldn't be an eligible basis. Obviously, that would not be a good answer. Please share with our audience, drum roll please, what IRS guidance is out there in impact fees and what that IRS guidance means.
Yeah. So fortunately, we have some good guidance. IRS has weighed in on impact fees and considered those impact fees to be considered capitalizable indirect costs. So just kind of how the projects have other indirect costs, such as interest, maybe engineering fees or other type of fees. Those impact fees are also considered a capitalizable indirect costs according to the Internal Revenue Code, specifically under Section 263A, which allows us to capitalize costs to the building.
Yes.
Which is good news, right? Because then if it's capitalized to the building, then that means it's eligible basis. And you really want to watch out for these because it could be significant amounts. So we don't want to, again, confuse them with other, if you have impact fees, you want to make sure that you're identifying those separately and making sure that we're treating them correctly.
And this also plays in with the strategy developers can be using sort of upfront. You want to make sure you're working with a tax professional, hopefully a Novogradac tax professional, as you're negotiating impact fees with the local government to ensure they'll be includable on an eligible basis. And also when you're thinking of other costs that the local government may want to force you to put in place or incur in order to get your various permits and approvals, to the extent that you can be negotiating higher impact fees for certain other costs that might affect ability to include an eligible basis. So just make sure when you're negotiating with a local government about various additional costs that you're going to incur to get your necessary approvals, that you're cognizant as to what you're going to do and why, because that'll affect the ability to include costs in eligible basis. Anything else you wanted to say about our 3 cost categories?
Yeah, and just also kind of watching out with your states. And if you're working in different states, making sure that the states and the forms that you're using for your cost certification for the states may or may not identify these categories and may or may not treat them as eligible. So sometimes, again, understanding what the costs are and if they're eligible so that you're reporting them properly to your state. So every state's forms are a little bit different. Unfortunately, we don't have one form that everybody uses. So you definitely want to watch out for these types of categories and make sure you're reporting them properly so you're getting the maximum eligible basis that you can for your project.
And that's a good point about reporting correctly and being sensitive to what the state doesn't allow, because everything we've been talking about here is for federal income tax purposes. For the federal long-term tax credit, is this or is this not included on an eligible basis? That doesn't necessarily mean the state allocating agency or the credit allocating agency, may not be a state, that they necessarily will allow that to be included on an eligible basis. So you have to know both the federal rules, but you also have to know what the rules are for the state. So that's always one of the reasons why, most developers won't do just one LIHTC property in one state because there's a learning curve that you want to amortize across more than one development. So this has been really helpful, Christina. To our audience, I will include Christina's contact information in today's show notes. But before we go, if you could share some other resources, Christina, that you'd recommend our audience follow up with, if they want to get more information about eligible basis with respect to these costs we described, eligible basis more generally, or just LIHTC more generally.
Yeah, sure. So definitely our Novogradac website is super helpful. We discuss some revenue rulings, particularly geared towards these kind of costs that we talked about today. So our affordable housing page on our website has most of the private letter rulings and rev rulings that are specific to LIHTC, all kind of bookmarked there for you. So that's definitely something you want to be visiting. But also for any new developers or maybe some existing developers that are not yet part of our LIHTC working group, we recommend that you join the working group. We meet monthly and discuss current issues, and a lot of it too is issues that are affecting the community as a whole, the LIHTC space, and advocating for changes that make sense to the LIHTC developers and investors. So definitely want to stay tuned to that. And then, of course, you mentioned before our conference. So we do have our developers conference in January of 2026. So it's just about a month away. You can register. Mike said he'll put a link in the show notes,
Yes.
but it's also on our website. So we definitely want to see everybody there, get to meet you in person, and also just a great learning opportunity. Our conferences are prefaced by one day of workshops. So we do have a LIHTC basics workshop and an AC rehab workshop. So those are great learning spaces. Smaller groups, great place to ask questions and meet people and learn from other developers as well. So definitely a great place to meet and learn.
Great. Thank you for that, Christina. And I'll be there as well, as you know. So I look forward to meeting some of our listeners or viewers if you're on YouTube. So please do join us in Fort Lauderdale beginning of next year. So Christina, thank you for joining me on Tax Credit Tuesday. Please do stick around for our off mic section. But before we go to that, every week I like to encourage our audience to subscribe to Tax Credit Tuesday, whatever platform or platforms that you get your podcasts. If you're watching on YouTube, and you can do this also if you're listening on Spotify or Apple Podcasts or something, take a moment to like the video if you're on YouTube, or the podcast, the audio on one of the other podcast platforms. If you take a moment to like and or comment on the episode, it does help raise our visibility. And we don't charge for the podcast. So think of that as the rental fee. Just give us a thumbs up on the podcast. Also, please do share the podcast with your colleagues. It's always a good way to get them started on the many incentives we cover, as well as refresh their memory, even if they're pretty experienced. Even myself, whenever I go to a conference, there's always one or two things that I learn. Same thing when I listen to podcasts. Much of it I might already know, but there's always a few tidbits that I take away. And we do have a full archive of our episodes available on our website at Novogradac.com. That would be 899 episodes. And not bad for one person's work. Yeah. And obviously it's not one person's work. It's me and all my guests' work. So thank you for your contributions to the 899, Christina. So let's turn to our off mic section. And we like to use this space to give a shout out to others that are working in the tax credit and tax incentive communities. Give us a chance to honor them for all the great work that they're doing. Christina, who would you like to shout out?
Okay, so I wanted to shout out Cameron Hill. Like I mentioned before, we are having a workshop, and I'm specifically going to be hosting the acquisition rehab workshop, but I did it last year, did it this year. I like doing the workshops because, like I said before, it's a great place to kind of teach, and people learn a lot from it, and we get a lot of great questions. But this year we have Cameron Hill from RBC Capital Markets. Cameron is joining us to kind of discuss financing structures, specifically with respect to tax-exempt bonds. It's something that we've had in mind to do, and maybe it'll go from workshop to webinar, maybe. So
I like it.
Yeah, we have a real excited to have her on. She's a great person to work with. We worked on projects together, and she's very knowledgeable. So I'm looking forward to working with Cameron Hill on our workshop. So
excellent. I look forward to seeing Cameron in Fort Lauderdale. So I'll echo your shout out.
Yeah. And then I just had one other shout out, Mike. I just wanted to take a couple of minutes to shout out Renee Beaver. Renee is a partner at Novogradac. Many of our listeners know Renee. Renee's been in the industry for many, many years. She's been a great resource within the firm to all of us, and specifically myself. I kind of grew up under Renee, worked with her for 20 years, I think. And so Renee's retiring, so I just wanted to take a minute to thank her and let her know that we wish her well in her retirement. We were super happy for her. So she deserves it.
Great. Thank you for that. I'll echo that shout out as well. Renee's been a wonderful partner. You couldn't ask for anything more from a partner than what Renee delivered. And I'm sure many of our listeners and viewers on YouTube have worked with Renee over the years and echo our sentiments. I do encourage you. You have you have a week plus left to be able to send a quick email to Renee and share with her your thanks for all that she's done, both to help you, however she's worked with in the past, as well as affordable housing, community development more broadly. And to our audience, I'm Michael Novogradac. And let me actually, before I do that, thank you again, Christina, for being on the podcast. And to our audience, I'm Michael Novogradac. Thanks for joining us today, and have a happy holiday.
Happy holidays, everyone.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.